At the beginning of last year, Morgan Stanley equity strategist Michael Wilson was one of the few to predict stock market losses. He was proven right, as the S&P 500 had its worst year since 2008.
But it makes sense why we're seeing this type of price action. We do have this collision between tightening Fed and slowing growth.
This year, he's projecting that stocks will fall even further. I'm going to explain just how far Wilson thinks stocks will tumble, why he believes the market won't recover this year, and break down what the numbers tell us about the current state of US equities. Let's get into it.
Given that we are about to enter the last calendar month of the first quarter later this week, we think the risk of stocks falling further is high.
In a note written in late February, Michael Wilson said he expects the S&P 500 to fall 25% from its current levels this year. That would knock the benchmark US stock index down to levels it hasn't touched since the spring of 2020. This is well below the norm among equity analysts at the big banks, and it's got many calling him the biggest bear on Wall Street. So why is Wilson so bearish? First, he argues that stocks are currently very expensive given the risks that the market is facing. He points to what's known as the equity risk premium, or the expected return for stocks versus an investment in US Treasury bonds. According to Morgan Stanley's calculations, that's at the lowest level since 2007. Second, Wilson says that even though stock earnings are expected to decline, analysts are being far too generous with their projections. He thinks that companies are going to underperform, and that will push stock prices down even further. And third, Wall Street's biggest bear agrees with many other strategists who say the Federal Reserve is far from done raising US interest rates and tightening financial conditions. If rates go higher than investors are expecting, that will put even more pressure on companies and consumers. The data certainly suggests there are reasons to be worried about stock prices. Earnings for companies in the S&P 500 are expected to fall by nearly 5% in the latest quarter. That would be the worst since the third quarter of 2020. And companies' net profit margins, or the percentage of every dollar of sales they make as profit, is expected to fall for the sixth straight quarter. The Fed's latest survey of loan officers also shows banks keep raising their standards, and fewer companies are coming to them for loans. There's also the fact that investors can earn close to 5% by keeping their money in one-year US Treasury bonds, which are considered risk-free since the US government has never defaulted. To be sure, many top money managers, like the equity strategist at JP Morgan, believe stock prices will rebound from 2022's big losses because the Fed will reverse course and start lowering interest rates later this year. They believe that will drive money back into the market and push stock prices higher. But Wilson and other strategists at places like Barclays, Deutsche Bank, and Jefferies see the Fed holding rates high in order to battle inflation, even in the face of a painful recession. Only time will tell who has it right. When markets are uncertain, it's always wise to keep putting money away, like rapper Smoke DZA says. He notes, "Every 200 I make, I gotta tuck 40. Have me 2M saved by the time I touch 40. That's all for now. See you next time.